As we said earlier, your support is appreciated. So you can sign up. We have the ability. It's a small amount per year. I think our entry is $500 for the year, and you get insights. My rantings outside of just this, but also my rantings in the insights. So please reach out if you'd like to learn more. So now when we turn to this specific chart, for those that know, we like to look at, what are motor fuels doing or mobility fuels. So the last week we were at 14.45. We had said that was low, and we did expect an increase, and it came at 14.88. So you can see that we're right at that white line, which is just 2022. So we're still under 2021, where if you remember 2021, what did we had? We had a lot of people driving. They're done with the lockdowns. Still not back to normal, but again, people were active. You had some nice moves, and you did have a huge shift in trucking, which pulled in more distillate. Here you're not having any of that. You're having kind of a muted reaction. So we do see this trending much closer to 2022, and likely a bit worse, and not by much. It's not like we're going to get this big collapse. It's just we don't see, we thought we were going to get above 15, we thought we were going to get above about 14.8 million barrels a day of demand. We still think that's the case. It's just we thought there could be a chance that we could push towards 15 million, depending on how core driving played out. And you can see it's really coming out with a whimper. We have seen a bit more activity on the trucking side, just because we've had additional flows. Yellow, where I think it was UPS was able to avoid the Teamster strike that we still need to understand. And then the yellow is going bankrupt or will file. So you are seeing some pivots. So we have to figure out how much of that is noise, how much of that is real. But you are seeing a bit of a pickup in general in terms of the trucking side. So again, we're getting some of that support. So even as gasoline disappoints, distillate's a little bit better, and that's going to keep us here, but still well off of the normal, or that's 2017 to 2019. Distillate had a small draw of 250,000 barrels, still 19.8 million below the 5-year. As you can see, Pad 1 is where all of the issues reside. Pad 1 is 14.6 million below the 5-year. That's a bigger problem, especially as we head into the winter months. They're going to have to find a way to fill that gap, and that's why we have seen spreads get support in the Gulf of Mexico. We have seen support in Singapore and Asia, and a lot of that is just because, again, even here you can see storage remains fairly low, very supportive of some of these crack spreads. Imports were up 97,000 barrels a day. It was all driven by Pad 1, which is going to continue to compete and try to pull in some of these additional flows. Here's where you can see some of the break to the upside. Cracks in the U.S. are about $40 for diesel. Given this is on NYMEX, this doesn't factor in some of the pieces like costs, but $40, even if costs are up, you're still going to operate, you're still going to run, you're still going to try to max out your disti crack, especially given where production is. Production did fall. You did get a little bit heavier in gasoline, but still on the low end. And production on the disti side should continue to be a bit more robust. And then as those additional flows, as we talked about in segment 1, we have a decent amount of distillate coming into the market from Russia. And a lot of that is signaling South America, and South America is where the U.S. exports a lot. So it'll be interesting to see how that kind of plays out as we go through not so much now or August, but that's going to be more of a September event in terms of how it would show up in the numbers, just given lead time and sailing time. When you look at Pad 1, this is the problem. We're very much at the 2022 levels. This is not a good position to be in. Last year we were lucky, and we did have a fairly mild winter in the Northeast. The Northeast is still your largest consumer of heating oil. Remember, heating oil, based on the new regulations, is equivalent to road fuel. So road diesel, heating oil is the same. So again, this is going to become a bigger problem. Where Pad 2 fairly comfortable, still at the higher end for 2023. We don't see too much up or down. The crack spread is there, so you'll see as much production as possible. But, exports right now have been able to maintain that. As exports diminish, one of the things that we said initially was that the ARB had closed. You were going to get a pressure on exports. Then that ARB opened right back up, and that's where you saw those exports continue. As that Russian product comes down, it'll be interesting to see how that impacts. Does that close the ARB? Right now, right now they're fine. So it'll be important to watch in general. When you looked at product demand, you can see we're below the 5-year average. We typically have a bit of a bounce. We see it continuing up, but as we were saying, we're not going above the 5-year. We're just going to go a bit sideways and still remain well off the 5-year average. So when you look here, the market demand index, it's actually getting worse here, but on the freight wave side, it's showing a little bit better. So when you take it together, realistically, we're probably just kind of flat, maybe slightly up, but nothing. When you go back to historics, there's nothing here that's going to make up for some of the declines that we've had in gasoline, obviously the declines that we've had year on year. So here's where you continue to see some of that lackluster and sluggishness. We have seen some rail pickup. Total carloads are down 1.3%. A lot of that, coal, one of the things that we talked about is coal stockpiles are pretty comfortable. So we're not getting a huge amount in coal. Forest product grains continue to be under pressure given the yields issue and underlying volumes. Then when you look at metallic ores, motor vehicles continuing to be lights out, there's still a backlog. There's still stuff to be done. If I could, I'd wait and not try to buy a car now. Petroleum products are supportive as you have products coming down from Canada, as you have some of that products going north. But then intermodal still low, 4.8% off of normal, off of last year. We did get a bit of a bounce of about a percent. That's something that should stick just because you are losing some of that on-road volume when you look at yellow, some of the other uncertainties with the Teamsters. So again, that's going to help support some additional volumes going to the rail system. When we look at underlying volumes coming into the coast, very underwhelming. Again, there are vessels within 40 nautical miles, 0 average time awaiting berth, 0. Again, it's just kind of normal. If anything, it's likely, obviously the numbers look much bigger. We're probably 2 to 3% down below normal, which is, if you think about volume size, that's a sizable number. But it's not like we're collapsing. It's just we're not seeing a huge amount of demand, which is why we don't see a lot of follow through on some of these increases in activity on the distillate front. When we look at temperatures, things in the Northeast and some of the Mid-Atlantic look fairly comfortable. That heat dome, as you can see, has shifted over to sit over not only just Texas, but also Louisiana. For those that live in Louisiana, I'm sorry, because I have been there in the dead of summer. And it's the one place that God said 100% humidity is not enough. We are going to defy physics and will allow Louisiana to have 150% humidity. So I feel you. I'm sorry. But as you can see, it's going to be toasty down there. That'll support natural gas in the near term, not a huge amount just because, gas is still enough supply. We don't see a huge surge in general. But as you can see, things are going to remain a bit toasty as we crest into August. Gasoline had a draw of 790,000 barrels. We're still 17.3 million below the 5-year. But again, it's really being driven by Pad 1, Pad 3. So Pad 3 and Pad 5 had draws. Pad 3 of 1.89, Pad 5 of 1.14. Pad 2 had a sizable build of just over 2 million. So again, you're getting some of this mix back and forth. Imports were up 36,000 barrels actually across the board. We're about 117,000 below the 5-year, but 154,000 above the year on year. We do see, as we've been saying, we do see it cresting over the 5-year, but not a huge amount. We were expecting something closer to about 800 and 850. We're at 753, so we do see a bit more of a bump. we're not getting this huge unlock just because shipping rates are a bit higher. That's keeping some of that product that we see in Europe just kind of stuck over there. At some point it will start to trickle over, but it's going to take some time. Finished motor gasoline is a little bit different. It did have a draw of 2.1 million, but that's only 5.3 million off the 5-year. Where blending components had a build of 1.3. The 5-year it's about 12 million below the 5-year, but you get an idea that there's this back and forth where blending components continues to rise. We're getting some of that left in there because there's not a huge demand on the pet chem front, and that's a bit problematic, which is again leaving more in the blending side. We do see that creeping higher, but you're seeing that gasoline demand is kind of underwhelming. Imports are a bit underwhelming as well. We do see a bit more, but we thought storage was going to move closer to 2022 levels. So far, pretty underwhelming. We don't see a big drop though, and that's that. So the comps will get easier through August. As you can see, there's typically that sizable acceleration. We don't see that just because of demand, because of imports. So again, the comps will improve, so that 5-year average will get better without huge builds in storage is essentially what we're saying. So when we're looking at blending starting to turn back up, one of the things that we had said we're going to get closer to that 10-year average and much closer to as you can see, there's typically that sizable drop. We just see this staying sideways, so the comps will get a bit easier. And when we look at Asia Pacific demand, rolling over a bit. When you look at Europe, sizable drop. Now we're a bit worse. When you look at the 4-week rolling average, we're about 82.8% off of normal in North America. When you look at Europe, about 90% and falling. We're down to this latest week of 80%. So, realistically, what we see, and as what we were saying, is in North America, we were going to have a big dip because of obviously July 4th. We're going to get back up, but then just flatline. We weren't going to close the gap. Europe, we thought, wasn't going to have the same type of drop, but obviously here we are, and it was a sizable drop. And as we were saying, Asia Pacific is going to be a problem. You're starting to see some issues. Nigeria got rid of some of their subsidies on gasoline. We do see a bit more of that happening. According to GasBuddy, U.S. gasoline demand rose 0.7% last week compared to the prior week, which they modeled 9 million barrels a day of demand. When you look at EIA, they were at 8.939. For us, we were looking at something closer to about 9.1. So we do see upside. There's likely another 200,000 barrels a day of demand coming. It won't, based on how kind of sluggish things are, it's not going to come all at once, but we do see that cresting to that level, still being fairly missing the mark. This is going to weigh on some of that demand. Gasoline prices are starting to edge higher. As they edge higher, people were already struggling. You were already seeing a sluggishness in demand and driving and activity, and sending the national average from 3.49, 3.5, $3.50 to $3.63. That's not how you're going to increase demand. So again, that's going to be another pressure point going forward, which is why when you look at the demand, we thought we were going to get a little bit of a bigger spike, and you can see it just fell flat. We do see that cresting back up. We thought we could likely hit that 9.3, 9.4 level, but that's looking a bit tough right now. Prices going back up, more sluggishness on the consumer side based on some of the leading indicator data. Red Book being one of them, looking at retail sales, is going to help that fall flat a bit. Propane, had a build of just over 17 million over the 5-year. You can see going back to 2015, setting records in storage. Again, that's putting pressure on pricing, helping our exports, because even though it's hurting realized prices coming down for the producers, it's helping us stay competitive in the international market. Jet had a demand spike, as you can see here, similar to what we had in 2022. We do see that just dropping back down, as we were saying, averaging 1.55, 1.65. Jet stocks did have a draw of 1.12 million. That's just 0.2 million below, or 200,000 barrels below the 5-year average. So as you can see, it's just balancing out. and it'll drop back down, as we were saying. When we look at the 12 weeks ahead passenger departure schedule, you can see that there's a bit of a slowdown, but that should be normal because you're getting into that October period. So things are pretty stable when you look at what's coming up. Flight schedules, when you look at delays increased a bit on July 19th. Not surprising for those that that have had the unfortunate movements in terms of flying, but that's where that's going to move around. TSA, slightly, this is looking at the 7-day moving average. We're right in line with 2019. That's kind of what we've been expecting. Not too much there. Eurocontrol, staying below 2019 levels. It's literally just been a percentage sideways. We see that holding the remaining the case. Better than 22, worse than 19, and that continuing. And then when you look at eating out, when you look at open table, Germany is the bright spot. Everything else is down anywhere between 5 and 7%. So the Germany is skewing that global just a bit. Things between the U.S. and Germany, things aren't as bad. U.S. is only down about 2%. But you're getting an idea that you are getting some of that weakness on the demand side when you're looking at eating out, especially as inflation continues to go up. Food prices are going to trend higher, especially as you have more of that pressure, as we talked about with India, banning the export of non-basmati rice. Now it looks like Russia is preparing to set up a blockade of the Ukrainian coast. So these are going to be some bigger issues going forward. So that's what we have for you here. Next segment, we're going to go deeper into the physical market, the global market, with a bigger hone in on where is demand and what is happening in China right now.